Welcome back to Talk Tickers. It is Wednesday, February 4th, 2026, and we have a massive one on the desk today.
We certainly do.
We're looking at a company that feels like it's bending the gravity of the entire healthcare sector around itself. We are, of course, unpacking the Q4 2025 earnings call for Eli Lilly.
And if you've had an eye on the tape this morning, you know this wasn't just some standard quarterly print. This was a statement.
A statement is right.
Yeah.
I mean, we are seeing a double-digit move intraday. The stock is up about 10% in early trading.
Pushing right past that $1,100 handle.
For a mega cap pharma company to move like that on a Wednesday morning, it just implies something structural has shifted.
It has. And to really get why the market is reacting this aggressively, you have to zoom out a bit. For, the last 6 months, the street has basically been holding its breath on Lilly.
Right.
The question was never about demand. We all know the world wants Mounjaro and Zepbound. The question was a credibility check on their industrial capacity.
The physics problem we've talked about. It's one thing to have a great drug. It's a whole other thing to actually make it at scale.
Exactly. Investors were asking, can Lilly industrialize this trade? Can they do it without tripping over their own shoelaces? And the answer this morning was a resounding yes. This was a durability confirmed moment.
Okay, so let's get right into the numbers, the result snapshot. What actually hit the tape?
Well, it was a clean sweep right across the board. Top line revenue came in at $19.29 billion.
Wow.
That's up a staggering 42.6% year over year.
And just to put that in context for you, the consensus, what Wall Street was expecting, was parked at, what, $17.94 billion?
Right, so that's a $1.35 billion beat on revenue alone. That kind of gap for a company this size is just massive.
It's huge. And sometimes when you see a revenue beat that big, you worry a little about margins. Do they have to overspend to get there?
A fair question, but no, it flowed right down to the bottom line. Adjusted EPS came in at $7.54, which just smashed the consensus of $6.91.
Okay, so the backward-looking numbers, Q4, were stellar. But the market is a forward-looking machine. The stock didn't pop 10% just because of December. It's because of what they said is coming in 2026.
That's the key. The guidance was the real shocker. They're projecting full year 2026 revenue between $80 and $83 billion.
80 to 83.
And they're guiding for an EPS of $33.50 to $35. Both of those ranges are just significantly above where the street was.
I want to pause on that because there's a bit of game theory here. Usually management likes to, sandbag, lower the bar so they can step over it.
Sure, manage expectations.
But Lilly is raising the bar here. What does that signal to you?
It signals visibility, specifically into their manufacturing plants. They basically said the Q4 growth was all Mounjaro and Zepbound volume, a demand-led scale-up, they called it.
So they're telling us we know how much we can make and we know we can sell every single drop.
That's it in a nutshell.
Which brings us to a really interesting point, the strategy. Because there was a nuance in the revenue mix that's easy to miss. You said volume is up, but I realized price actually went down.
That's right. And this is where you have to pay attention. In the U.S., revenue was up 43%, but realized prices actually declined by 7%.
Okay, so play devil's advocate. We want pricing power, right?
Yeah.
So why are they charging less and why is the market cheering?
Because it's a strategic trade-off. They're aggressively trading price for volume. They're opening up the floodgates to government access, like Medicaid. To get on those formularies, you have to offer rebates. You have to lower the net price.
So they're sacrificing a little bit of margin per unit for massive market share.
Precisely. It's a mass market volume game. They're building a moat that competitors just can't cross because they don't have the manufacturing scale.
And speaking of access, there was that detail about Zepbound vials. The self-pay vials are now, what, a third of all new patient starts?
A third. It's a huge statistic.
Why does that matter so much?
Because it's about bypassing the friction of the insurance system. Those vials are a cash pay, direct-to-consumer play.
So no waiting for a prior authorization?
None. They're going to Lilly Direct, putting down a credit card and getting the medicine. It turns a patient into a consumer subscriber.
And the Netflix model for weight loss?
In a way, yeah. But none of this works, none of it, if you can't actually make the drug. And that's where we get back to physics.
You've called it physics constrained before, not demand constrained.
Exactly. The problem was never finding customers. The problem was building sterile fill-finish capacity. It's just incredibly hard to scale.
And they've spent something like, what, $55 billion in CapEx since 2020?
$55 billion, the GDP of a small country. And on this call, they confirmed it's paying off. They produced 1.8 times more doses in the second half of 25 than the year before.
So those new sites in North Carolina and Wisconsin are officially online.
Online and ramping. They're winning the battle against physics.
Okay, so they're winning the supply war. But the bull case isn't just selling more of the same. The pipeline updates in this call were, frankly, startling. We have to talk about the next leg.
You're talking about orforglipron.
The oral pill. This is the holy grail, right? No needles.
Submitted to the FDA, approval expected Q2 2026. But the data they shared from the Attain-Maintain trial is what changes the game.
Attain-Maintain. Okay, what did it show?
It addressed the biggest fear. If I switch from the shot to the pill, will I gain the weight back? The data showed patients maintain their weight loss within 0.9 kilograms.
That's nothing. Basically, you keep the results.
You keep the results. But here's the kicker, the competitive edge. Management highlighted that orforglipron has no restrictions on food and water intake.
That is a big deal because with the other oral options, you have to wait 30 minutes before you eat or drink anything. It's a hassle.
A huge hassle. Lilly's pill is just a pill. You take it and go. This expands the market. It brings in all the needle-phobic people. It grows the TAM.
So that's the convenience market. But then we have the triple G, the monster, Redditure Tide.
This is the heavy hitter.
Right, the GIP-GLP-1 glucagon triple agonist. The Triumph-4 trial data came out. 29% weight loss. I mean, that's getting into bariatric surgery territory.
It is. 29% is phenomenal. But honestly, that wasn't even the most shocking number in the report.
Okay, lay it on me.
The shocker was about osteoarthritis. In patients with obesity and knee osteoarthritis, Redditure Tide resulted in a 76% reduction in knee pain.
Wait, 76%? That seems impossibly high.
76, and 1 in 8 patients became completely pain-free.
That's practically knee surgery in a syringe.
That is exactly how investors need to be looking at this. This moves the narrative completely away from cosmetic weight loss. This is for high BMI patients with serious comorbidities.
Right.
When you can go to an insurance company and say, we can reduce knee pain by 76% and maybe avoid a $40,000 surgery, that changes the whole conversation.
It becomes a structural medical necessity. It changes the math for the payer.
Precisely. It turns the drug from a cost into a cost-saving tool.
Incredible. But we have to do our don't forget the rest segment. Lilly isn't just an obesity company.
Not at all. And that diversification is key. It's a hedge. So for Alzheimer's, their drug, Kisunla, is now the market leader. Over 50% share.
In a notoriously difficult market. And oncology.
A big win there, too. Pirtobrutinib, brand name Jaypirca, got full approval. The data showed it reduced the risk of progression or death by about 80% versus chemo in CLL.
An 80% risk reduction. Wow.
And then you see them getting serious about immunology. They bought Ventyx for $1.2 billion. They're even testing Zepbound combined with Taltz for psoriatic arthritis.
So treating the inflammation and the obesity together.
Exactly. It's a flywheel effect. It shows they're thinking holistically.
Okay, let's pivot to the investor context. Management guided for a low to mid-teens price drag in 2026. Why did investors just shrug that off?
Because in this case, volume is king. The volume growth is so explosive, revenue jumping 25% at the midpoint, it just completely swamps the pricing pressure. It's the Amazon strategy.
Scale wins.
Scale wins. And that connects to what Dave Ricks, the CEO, was saying about the consumer analog.
Yeah, he said Lilly Direct has over 1 million patients now.
1 million patients. And he admitted there's no historical analog for this. We've never seen so many people willing to pay out of pocket for a drug like a subscription. It's behaving more like a consumer staple.
Which makes modeling it tricky, but the upside.
The upside is a massive TAM expansion. It suggests the stock isn't just a drug company, it's becoming a consumer brand.
So the verdict.
The 10% move says the market cares about 2 things right now, capacity and pipeline. They'll worry about margins later.
It's a fascinating setup. All right, that brings us to my favorite part of the deep dive.
The "this is not financial advice" segment.
Huge disclaimer. For entertainment only, do not actually do this. But looking at that Redditure Tide data, I have an idea.
Let's hear it.
I'm calling it short the surgeon, long the active living economy.
Okay, unpack that.
So the logic is Redditure Tide cuts knee pain by 76% and weight by almost 30%. Less weight, less pressure, less pain.
Right, simple physics.
So if you're a company that manufactures artificial knees and hips, your Strykers, your Zimmer Biomets, you should be terrified of 2027.
That's actually a plausible long-term risk. If you can take a shot and cancel your surgery, you're going to take the shot.
Exactly. The market for elective joint replacement could collapse. So we short the hardware makers. But here's the other side of the trade, the hedge. We go long on active living.
The active living angle.
Think about it. You've had chronic knee pain for a decade. Suddenly you're pain-free and 30% lighter. What do?
You don't just sit on the couch.
You go out. You buy the hiking boots, you book the cruise, you buy the expensive bicycle, you're betting on the experience economy for the aging population.
So it's the grandma goes hiking ETF.
Exactly. You buy travel stocks, athletic wear, anything that caters to an older demographic getting back in the game. If they're not on a hospital, they're on a trail somewhere.
So the spending shifts from healthcare maintenance to lifestyle enjoyment.
There you go. Short Zimmer Biomet, long REI. You heard it here first. Again, please do not trade on that.
Please don't. But it really highlights just how disruptive these drugs are. It's not just about waistlines. It's about how society functions.
It ripples through everything.
Well, today was a big step. To recap, Q4 was a clean beat, FY26 guidance is a monster, and the pipeline secures the future.
Lilly is effectively telling the market, we are the king of the jungle. And today, the market agreed.
It certainly did.
Indeed. Check your portfolio, check your blood pressure, and we will catch you on the next deep dive. Thanks for listening to Talk Tickers.